Hey everyone, and welcome back to the channel. If you're a freelancer, a rideshare driver, a content creator, or part of the booming gig economy, this video is for you. Today, we're diving into the ultimate guide to legally minimizing your taxes. We're talking about keeping more of your hard-earned money in your pocket, not giving it away to Uncle Sam. Let's get started. First things first, let's understand the basics. As a gig worker, the IRS generally sees you as self-employed. This means no employer is withholding taxes for you. You're responsible for paying both income tax and self-employment tax, which is about 15.3% for Social Security and Medicare on any net earnings over $400. The goal here isn't to avoid taxes, but to legally reduce your taxable income using deductions, credits, and smart planning. Done right, this can save you thousands every year. And remember, while I'm sharing some powerful tips, it's always a great idea to consult a tax professional for advice tailored to your specific situation. So, how do you actually pay these taxes? All your gig income, even if it's a side hustle that made less than $600, is taxable. You'll report it on a form called Schedule C, which you attach to your main 1040 tax return. That 15.3% self-employment tax might sound scary, but here's a silver lining. You get to deduct half of it, which is 7.65%, as a business expense. This automatically lowers your overall tax bill. Now, to avoid a nasty surprise and penalties at the end of the year, you lines likely need to make quarterly estimated tax payments if you expect to owe more than $1,000. These are typically due around April 15th, June 15th, September 15th, and January 15th. The absolute foundation of saving money on taxes is meticulous record keeping. I can't stress this enough. The best way to do this is to open a separate business bank account and credit card. This keeps your gig finances completely separate from your personal spending, making everything crystal clear. Use a spreadsheet or an app like QuickBooks Self-Employed to log every single dollar that comes in and every dollar that goes out. This isn't just for tax time, it's your proof if the IRS ever comes knocking. Keep these records for at least 3 to 7 years. Pro tip, if you also have a regular W-2 job, you can often just increase the tax withholding there to cover your gig taxes, avoiding the need for separate quarterly payments. Now for the fun part, deductions. Think of deductions as erasing a portion of your income, so you don't have to pay tax on it. You can deduct any expense that is ordinary and necessary for your business. For many gig workers, the biggest deduction is your vehicle. You can track every mile you drive for your work, whether it is for deliveries or driving to meet a client, and deduct it using the standard mileage rate, which is updated annually. Or, you can deduct the actual costs of gas, repairs, and insurance. Just remember, you have to pick one method and stick with it for the year. But it doesn't stop there. Do you have a dedicated space in your home that you use exclusively for your work? That's a home office deduction. You can deduct a portion of your rent, utilities, and internet. Then there are all the supplies and equipment, your phone, your computer, software subscriptions, marketing costs, and even the fees that platforms like Uber or Upwork take. If you pay for your own health insurance and don't have access to a plan through an employer, you can deduct those premiums too. Every legitimate business expense chips away at your taxable income. Let's talk about a huge tax break you might be missing. The Qualified Business Income, or QBI, deduction. This is a game changer. It allows most gig workers to deduct up to 20% of their net business profits straight off their federal income tax. So, if you made $50,000 in profit after all your other deductions, the QBI deduction could potentially make another $10,000 of that income tax-free. There are income limits, but most freelancers and sole proprietors will qualify. You'll use Form 8995 to claim it. This is one of the most significant tax breaks available to self-employed individuals, so make sure you're not leaving it on the table. Another powerful way to lower your tax bill is by saving for retirement. When you contribute to certain retirement accounts, you get a tax deduction for it right now. For gig workers, a SEP-IRA or a Solo 401k are fantastic options. With a SEP IRA, you can contribute up to 25% of your net earnings. A Solo 401k is even more flexible, especially for higher earners. You're not just building wealth for your future. You're actively reducing the amount of income you're taxed on today. It's a true win-win. Finally, don't forget about tax credits, which are even better than deductions because they reduce your tax bill dollar for dollar. The Earned Income Tax Credit, or EITC, is a refundable credit for workers with low to moderate income. Also, if you buy health insurance through the marketplace, you might be eligible for premium tax credits that lower your monthly costs. And a quick note on common mistakes: never underreport your income. The platforms you work for are reporting it to the IRS, and don't try to pass off personal expenses as business ones. It's not worth the risk. By being proactive, tracking everything, and taking advantage of every deduction and credit you're entitled to, you can significantly lower your tax burden and keep more of the money you work so hard for. Thanks for watching. If you found this helpful, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next video. See you soon.